Saturday, August 19th, 2023, Maneco 64, home of alternative economics and contrarian views. Today, we're going to briefly look at the U.S. economy, whether it's running out of gas. We've had some stories come out, some articles about that. Before I start, though, I'd like to thank all of you for your interest in the channel. And if you're new to the channel, make sure you subscribe to the channel. Make sure as well, if you enjoy my videos, to hit the like button, hit the little notification bell to be notified of all my new videos. I make a video every day. Sometimes I don't, but it's very rare. So if you have followed central banks and what they've been doing, you know, of course, they got way behind the curve about 18 months ago. Or maybe even a couple of years, they said that inflation was going to be transitory, that there was no problem. We're going to go back to the 2% level. I think they said it would have happened before the end of 2022, and lo and behold, it didn't. And why? Well, because of what happened in 2019 and 2020. And notice I didn't say just 2020, March 2020. So what happened in 2019? Well, I covered that extensively at the time. It was the repo crisis, the repurchase agreement market. It's a very niche professional market on Wall Street and other financial centers in the world, like the city of London. And basically, it's big financial institutions borrowing from each other, but with collateral. And the way they do it is they sell some treasuries to a counterparty overnight for one day, and then they buy it back at a higher price, and that's the repo rate. And it's usually a very smooth market, and it provides liquidity because these financial institutions, hedge funds, mutual funds, international banks, they all like leverage, and especially in 2019, when the world was still in a very low rate environment, they needed to hypothecate or leverage to get more return for their investors and policyholders, be it an insurance company. So that market is usually quite smooth because you have collateral, right? You have the U.S. Treasuries that you're selling to someone overnight or maybe for a week. Yeah, that's how the repo market works, and that the repo rate is usually very similar to the short-term Fed funds rate or the 1 month, 3 month T-bill rate, probably a little higher. But what happened in September of 2019 is that the repo rate exploded to like 10%, while the Fed funds rate was around 2%. So basically what happened, and we were told actually by the BIS and others that some hedge funds were in trouble, and that the repo market froze. So the Federal Reserve had to intervene and do not QE. They at the time, Jay Powell and the Fed were doing quantitative tightening. So that was in September, and 6 months later, March, everything kicked off, and we had, you know what, crisis. And that gave the central banks, not just the Fed, all the major central banks, the excuse to cut rates again. Because don't forget, back in 2017 up until 2019, the Fed was trying to unwind all the largesse of QE and zero rates that started after the '08 crisis. So what happened in March 2020 was a perfect excuse for them to reverse that and and say it wasn't our fault, it was because of what happened. But I would say the crisis really started with the repo market. It's a very important market, and they had to find something, right, to justify the massive amount of QE. And we know what happened. The Fed's balance sheet went from below 4 trillion to almost like 9 trillion. And we're still above 8 trillion right now. Yes, they have risen rates. So what's happening to the U.S. economy now? I said in the beginning that the U.S. economy is running out of gas. Well, Business Insider reports here, and this is from yesterday, Americans are exhausting their excess savings and could run out of funds this quarter, Fed study says. Why is this important? Well, because as the article says here at the end, the downbeat forecast comes as Americans prop up the economy through their strong spending habits, helping temper fears that the U.S. could slip into recession. But dwindling savings could pose challenges for the U.S. economy, given consumer spending is a key engine of growth. In one sign of falling savings, Americans are using their credit cards more, racking up nearly 1 trillion of credit card debt, Fed data shows. So there's another story here about that. I think it's in Forbes, on Forbes magazine. Americans' credit card debt tops 1 trillion, hitting all income levels. This is from August 17th. So I was talking about the repo crisis in 2019. It took 6 months for things to kick off. And I think we've had the beginnings of a tremor, of a crisis, and people are downplaying it, just how they downplayed the repo crisis back in 2019, early 2020. And it's the banking crisis we had in March. Don't forget that. And at the time, the Fed had to do not QE. They reversed a lot of their QT. They didn't cut rates. They have started to unwind the balance sheet, but and they have raised rates. But what they've been doing through the back door is providing a lot of liquidity to the banks with this bank term lending facility, or bank term BTPD, I think it's called, bank term. So what they're doing, the Fed, is they're spending tens of billions buying treasury securities that are underwater for these banks to make it look like their balance sheets are better than they are. And we've seen that treasury rates did drop recently, but they've been going up, and they're near like couple of decade highs. The 10-year yield, we saw it go up to 433 this past week. It did drop yesterday back down to 425. What I'm trying to say here is that we could be ripe for another crisis. If you add 6 months from March this year, you get to September. Am I sure it's going to happen in September? No, but it's pretty much the amount of time it took from when the repo crisis kicked off in September 2019 to March 2020, about 6 months. So what pretext are they going to use now? Well, I don't know. I'm not a fly on the wall, but I've heard a few things that we could see a repeat of 2020. Hopefully that won't be it. But it will give the central banks an excuse to reverse everything. The other thing that's pointing to maybe a massive, how can I say, infusion of fiscal and monetary policy, just like in 2020, is the fact that earlier this year, when we had the debt ceiling impasse, they decided to basically suspend the debt ceiling for 18 months. And it was quite unusual how the supposed fiscal prudent Republicans caved in so easily, especially Kevin McCarthy, who was like making speeches a month or two before saying, they don't want to do this. We're not gonna, and then all of a sudden he caved in. So why does that point to maybe a crisis? Well, because without a debt ceiling, as it's been suspended, the U.S. Treasury, Uncle Sam, can borrow and spend as much as it wants. So what happened, of course, to the financial markets when we had the crisis in 2020? Well, we saw a massive crash in everything. We saw heavy volatility in the Treasury market. We not only saw rates go down to 0.3 in the 10-year, but they also rose above 1 in a matter of days. It was all over the shop. So we saw gold and silver, of course, get hammered. Gold went from 1750 to like 1450, and then of course it went to above 2000. Silver dropped to like around $12, and then it went to 30.
With rising inflation, bank failures, and massive layoffs across multiple sectors, the future of the economy remains uncertain. It's no wonder the central banks have been getting prepared by stockpiling gold. At ITM Trading, we have spent over 27 years building a team of seasoned researchers and analysts who can help you prepare for any financial crisis. Our experts are ready to provide you with proven strategies to safeguard your wealth and assets in the event of an economic downturn or currency reset, which is frankly inevitable. Don't wait until it's too late. Schedule your free gold and silver strategy call by clicking on the link in the description below.
Am I saying we're going to see the same scenario again? Well, things are never the same. And what else could one do in terms of trading? And I usually don't give advice, and this is not advice. This is something that I was thinking of this morning. What would happen to U.S. Treasuries if we have another crisis and the Fed steps in to help? Along with the Treasury, well, they're going to have to do a lot more QE. It's going to be it's going to look the QE from 09 to 2015 or thereabouts look minimal. It's going to look the QE in 2020 to 21 also look fairly small. So they could inject massive amounts of trillions. And I've been talking with Clive and others, and many other people have been pointing out that the amount of debt in the system now and the forecast, even from the Congressional Budget Office, they're calling for a doubling of the debt in the next 10 years. And there's not enough money out there to support that. And the other problem America has, and Western Europe and the UK, is that a lot of the countries that used to buy a lot of our debts, they're trying to move away from our system, or diversify at least, and not be so dependent through the BRICS and also the global South countries. So yeah, that would be a perfect excuse. The other thing I was talking about trading, yes, buying a call option on TLT, which is the long-term iShares 20 plus year Treasury bond ETF, or you could buy the ETF. I mean, that's a way to play this if things hit the fan, so to speak. I don't want to talk about what crisis there could be, but because I want to stay here and warn you about things. And if I spoke about what I'm hearing, I don't think this video would be out there. So what I recommend you do is you go to my blog, Moneko64.net. I posted there something there yesterday that might enlighten you a little bit to what could happen. My hope is that it doesn't. Yeah, so there you go. We've got debt up to here, not just the government, but you've seen credit card debt, first time ever to $1 trillion. We're seeing that Americans are running out of savings, and according to the Fed, it could run out this quarter. That means end of September. And yeah, interest rates are high. Foreigners are not buying as many bonds. The Fed's supposed to keep doing QT. The banks are not out of the woods. You might want to add the situation in China, but I think it's not a distraction, but we've got problems as well. The banks in the US, the banks in the UK, the banks in Europe. And yeah, so that's how I see things. And with that, I'm going to wish you all a great rest of the day and a great weekend. Take care. Bye.